Hello, and welcome to CoValue app tutorial. Let's move on to the 6th module, What If Valuation. The What If Valuation module uses the discounted cash flow model. The module can be used for valuing any company, except banking, finance, and insurance companies. We suggest you watch our Know Your Worth tutorial before proceeding with this tutorial, as this video draws information from the earlier module. In this module, we will help you to analyze the value of a stock based on permutations and combinations of various value drivers. There are 4 scenarios of what-if valuation. If you want to create more scenarios, you will need to create a new valuation plan. The user has options to create a valuation plan from DataBank, edit an existing what-if valuation plan, import a valuation plan from the Know Your Worth module, or create a valuation plan without DataBank. For convenience, we create a valuation plan for Netflix with World DataBank from the What If Valuation module. We can change country DataBank to the respective country or exchange where the stock is listed and proceed after naming the plan potential. This example is just an illustration for the tutorial to understand the working of the app. All basic information, just like in the Know Your Worth module, is pre-filled in the screen. Users can distinguish multiple what-if valuation plans of the same company by naming each valuation plan differently. Advancing to the prior period screen. Information like the sales and operating profit margin in prior period are pre-filled through the DataBank. The user is allowed to edit this data. Advancing to the balance sheet screen, non-operating assets and liabilities. The balance sheet, non-operating screen essentially consists of non-operating items that do not contribute to generating operating cash flows. The non-operating assets and liabilities will need to be added or subtracted from the present value of cash flows from operating assets to arrive at the shareholder value or intrinsic value. This section is pre-filled and also displays the debt, non-operating liabilities, and the outstanding shares as on previous closing day. This data is editable. The breakup can be viewed by clicking on the history icon, the top right of the screen. Users need to review the investments in affiliates, non-operating real estate, and minority interest to reflect their fair value, as these may be taken at book value. Debt-equity ratio. Now we advance to the capital structure screen. The capital structure gives the breakup of debt at book value and market capitalization of equity. The app uses market value of equity to compute the debt-equity ratio. Advancing to the value drivers screen. There are 4 scenarios in which the value drivers for all the scenarios must be entered before computing value. Let us now enter the value drivers for all the scenarios for the forecast period and terminal period. Please refer to the history icon for historical data for each value driver on the top right of the screen. Sales in prior period is pre-filled and is non-editable. First scenario. In the first scenario for Netflix, let us initially take a forecast period of 10 years. Checking the sales growth in history tells us that Netflix has shown a compounded growth of 27% during the past 5 years and 25% during the past 10 years. The 12-month trailing sales grew by 12.5%, and for quarter ended September 30th, 2022 was 6%. In this scenario, we assume that Netflix will compound its revenues by 10% during the forecast period. We assume the target OPM to be around 20% based on the latest operating margins. The history displays the historic operating profit margin, EBITDA, and 5 and 10-year average margins for Netflix. The basis of our assumption is that the company will be able to sustain its margins. The incremental fixed assets to incremental sales for Netflix has been around 100%. Thus, we have maintained this incremental fixed asset investment rate during the forecast and terminal period. The history shows that the net working capital to sales ratio until the prior period is minus 19%. We assume the net working capital investment rate to be minus 20% during the forecast and terminal period. Income tax during forecast period. The marginal income tax rate is ideally entered for the forecast period, assuming the tax rate is expected to remain stable. For Netflix, we have taken this as 21%. The weighted average cost of capital assumptions during forecast period. We have assumed expected inflation rate to be 3.25% during the forecast period. The expected inflation rate should be less than the risk-free rate. There is an alert if this exceeds the risk-free rate. The user may wish to proceed despite this alert. The 10-year Treasury bond yield is pre-filled and is 3.67% as on the date of this exercise and is assumed as risk-free rate. Debt-equity ratio. The history of the capital structure gives the breakup of debt and equity. Debt is at book value. Equity is taken at the market value based on the last traded closing price. The app uses market value of equity to compute the debt-equity ratio. The history displays the following computation of debt-equity ratio based on current market capitalization. Enter the debt-equity ratio to be assumed during the forecast period. The debt-equity ratio for Netflix is assumed as debt at 10% and equity at 90%. Now we look at cost of debt and equity during the forecast period. The cost of debt is taken by looking at the risk-free rate and the default spread of the company. The cost of debt should be based on the currency in which the valuation is done and is for the forecast period. The cost of debt for Netflix is taken at 5.5%. Enter the cost of equity during the forecast period. Users need to refer the history icon to view computation under capital asset pricing model. Here, you can iterate the expected market return and beta and compute the cost of equity based on your assumptions and enter the cost of equity in the What If Drivers screen. Users can also deploy other models or just use expected market return, which is an implicit rate of return the investors expect in the stock market. The cost of equity for Netflix is taken at 11.32%, as per the computation in the cost of equity during the forecast period by the app. Please view the computation in the cost of equity during forecast period in the history screen. Advancing to the terminal period assumptions. The cash flows of the company continue post the forecast period and thus have value. Terminal period assumptions helps to forecast the cash flows into perpetuity. In this section, you will need to enter the expected inflation rate, risk-free rate, income tax, debt and equity ratio, cost of debt, and cost of equity expected during the terminal period. This will enable the app to compute the weighted average cost of capital during the terminal period. The user may click the history icon to check the history and CAGR of inflation for the currency for up to 30 years. Here we take 2% as the expected inflation rate during the terminal period. Ensure that the risk-free rate is greater than the expected inflation rate, as generally the Treasury yields incorporates the expected inflation rate. Here we take 2.25% as the risk-free rate during the terminal period. This is assumed as inflation of 2% plus real interest rate of 0.25%. Income tax. The marginal income tax rate is ideally entered for the terminal period, assuming the tax rate is expected to stabilize to this rate on average in the long term. For Netflix, we have taken this as 21%. Terminal period debt-equity ratio. The history of the capital structure gives the breakup of debt and equity. Debt is at book value. Equity is taken at the market value based on the last traded closing price. The app uses market value of equity to compute the debt-equity ratio. The history displays the following: computation of debt-equity ratio based on current market capitalization, debt-equity ratio entered by the user during the forecast period. Enter the debt-equity ratio to be assumed during the terminal period in the terminal period screen. The debt-equity ratio for Netflix is assumed as debt at 10% and equity at 90%. Cost of debt and equity. Now we look at cost of debt and cost of equity during terminal period. The cost of debt is taken by looking at the risk-free rate assumed in the terminal period and the default spread of the company. The cost of debt for Netflix during the terminal period is assumed at 4%. Cost of equity. Enter the cost of equity during the terminal period. Users need to refer the cost of equity during terminal period in the History section to view computation under Capital Asset Pricing Model in the User Input column. The cost of equity for Netflix is computed at 10.10% as computed by the app. We have iterated the beta for Netflix from 1.18 to 1 as we expect the beta to be closer to market returns. Thus, the recomputed cost of equity comes to 8.9%. We enter the cost of equity as 8.9%. The app will compute the weighted average cost of capital based on the assumptions entered. We now need to enter the terminal growth assumptions. We assume Netflix will be able to keep up with the inflation in the very long term. Hence, the inflationary growth for Netflix is taken at 2% as assumed in the terminal growth. The user may click the history icon to check the history and check the CAGR of inflation for the currency for up to 30 years. The real growth expected into perpetuity should take into account the country GDP growth rate, industry growth rate, and the world GDP growth rate. The user may click the history icon to check the history and check the CAGR of GDP growth for the country and the world for up to 60 years. Here, we assume Netflix real growth to be in line with the world GDP, and hence, the real growth is taken at 2%. You will need to ensure that the terminal growth is not greater than the weighted average cost of capital of the company. Now let's advance to the second scenario. Here, we have an option to duplicate the previous scenario. Here, we duplicate the previous scenario and then make changes in the value drivers. Thus, in the second scenario, we change the following. Forecast period is increased from 10 years to 15 years. CAGR of sales is from 10% to 12.5%. Operating profit margin is increased from 20% to 25%. Cost of equity is reduced from 11.32% to 10.15% by reducing the beta from 1.18 to 1. Finally, we reduce the terminal real growth from 2% to 1.5%. Now advancing to the third scenario. Here, we have an option to duplicate the previous scenario. Here, we duplicate the previous scenario and then make changes in the value drivers. Thus, in the third scenario, we change the following. Forecast period is reduced from 15 years to 10 years. CAGR of sales is changed from 12.5% to 15%. Operating profit margin is reduced from 25% to 20%. Incremental fixed asset investment rate to reduce from 100% to 75%. Finally, we increase the terminal real growth from 1.5% to 2%. Now advancing to the fourth scenario. Here, we have an option to duplicate the previous scenario. Here, we duplicate the previous scenario and then make changes in the value drivers. Thus, in the fourth scenario, we change the following. Forecast period is increased from 10 years to 15 years. Operating profit margin is increased from 20% to 30%, as we expect the depreciation and amortization, which is now 42% of sales, to come down in the very long term. Incremental fixed asset investment rate to reduce from 75% to 50%. Cost of equity is increased from 10.15 to 11.32% by increasing the beta from 1 to 1.18. Finally, we reduce the terminal real growth from 2% to 1.5%. Now, when we click Compute, the screen displays the shareholder value and shareholder value per share for each scenario based on our inputs along with the current market price. Users can either email the reports from here and share valuations with other subscribers of the app via messages in the app format. Thank you.